Welcome to the second part of our two-part series, an economic update as of January 2025. Looking forward to 2025. I have with me Brett DiPasquale. Those of you that are listening today, please note that I did a version of this on my own recently, and this is meant to pair with it. I asked Brett to join me. He wanted to share some of his thoughts on what I shared with all of you. We've also included a few talking points that we'll get to. But Brett, thanks for joining me today.
Absolutely. Thanks for having me and Happy New Year.
So you and I worked very closely for the entirety of 2024, including the rest of the team. And we spent a lot of time talking about our base case for a soft landing, as well as some reasons for optimism and some reasons to worry. I feel a lot of pride because I think we had a very good handle on what was going on. What is your takeaway from our sort of base case and thoughts about 2024?
Well, I think as we got into 2024 and gave our initial thesis on what we thought was going to happen for the market, it was the cautious optimism along with a presidential election year, a declining interest rate environment, or so we thought was coming. So I think when you really look at the first half of 2024, we nailed it. Everything happened kind of how we liked it to, how we wanted it to. But then once we hit the second half of the year, I think it got a little bit more tricky with obviously the turmoil overseas, with the changing environment with the presidential election. But overall, I mean, I think 2024 was a gangbuster year for markets.
Yeah, I agree. I think one area is that we did underestimate the strength of what the stock market could produce in 2024. But it really was a great year. And fortunately, some of the things that we were worried about, political uncertainty, I talked about the election, how fortunate we were, I think, that we had a clean election where there wasn't a lot of court recounts, a whole lot of craziness compared to 2020 and even 16. It was pretty calm, which probably is a benefit not just to the markets, but for the country as a whole. What do you think of that?
Yeah, I think that's the biggest thing. Markets like a surety. We got that with the election. Now the markets know who's going to control the presidency, the House of Representatives, the Senate, the balance of power. And I think for the good of the country, that was good that everything is just certain.
So our base case, if you will, our theme, if you will, for 2025 is that we could have a modest continuation of the bull market that began in October of 2022. And the idea is that the trend is your friend. The market has been trending upward for a while now. The conditions that led to that are mostly in place. We have a good economy, a growing economy, no recession on the horizon, pretty good job market, inflation manageable, not great, but manageable. And talked a little bit about the optimism of the new administration. Anything to add about this base case of a modest continuation of the bull market?
I think it's worth noting that our base case seems to be pretty close to what it was in 2024. So I think as we approach 2025, I mean, it's right along the same route of cautious optimism. Interest rates continue to trend down. It's really one of the same things we were looking at, but I think we have a more or a better understanding of what may happen here going into the first half of this year.
This year, causes for optimism. I identified it four. And keep in mind, if you're listening to this, I say I, but we as a team did this. There was a lot of input on this, including Brett. So it's not like he hasn't seen this or is at big odds with any of this. But we identified four things: optimism about the Trump second term, a benign Federal Reserve, manageable inflation. I already touched on that a moment ago. Healthy economic fundamentals. I also touched on. I wanted to get your opinion on the benign Federal Reserve. I believe the consensus is that the Federal Reserve is likely to cut interest rates 2 times in 2025. What is your take on the Fed's posture going into this year? And what do you think about the consensus view about 2 rate cuts in 2025?
I think going into this year, it's very important that the Fed stays consistent in what their messaging is going to be. So I think interest rates are going to decline, 1 or 2 cuts. I think we may get even more so of a cut than we even think, because I think by the Fed decreasing rates, albeit slower than originally thought, it's still going to be a positive to the economy. So as rates continue to decrease, although rates and savings accounts, all of that will start decreasing. It's also going to be a help for even maybe some of the home housing market and other sectors of the economy as well. But I think 2 rate cuts will be fair. I think they have to stay consistent in their messaging. And I think by cutting rates will show good faith, let's say. And I think that will also raise consumer optimism.
Follow-up question. If you assume the 2 rate interest rate cuts is consensus and you feel comfortable with that, if that is incorrect, if it turns out not to be the case, do you think it's more likely that we have more than 2 interest rate cuts, or more likely that we have, let's say, 0 interest rate cuts? In other words, if there is a miss, which direction is it going to be? That seems to be pretty important in my view on what's going to play out. What do you think is the more likely miss if 2 is not actually what happens?
I think the miss is up, and I'd be very confident on that. I think if it's not 2, it's not going to be 0. I think it's going to be 3, maybe even 4 is a long shot. I think it just depends on the direction of inflation. It depends on the um, direction of the economy. But to answer your question, up over 2.
I'm going to answer my own question, Brett, and I'm going to show people that are watching and listening to this the vibrancy of the team approach that we have at Elliott Wealth Management. Is that I would take the other side of that. I think if there's a miss, it's more likely that the Fed goes slower. And if you look at the recent job reports and this optimism around the Trump administration, and if some good policies could get implemented, including perhaps an extension of the tax law that was signed into law in 2017, the market, excuse me, the economy may be hotter and the Fed will go slower, not to risk reigniting inflation. So I think I would take the opposite side of that bet.
Well, in the spirit of competition,
Oh,
maybe we'll see who the end of 2025 team dinner will be on this year.
all right. I like that. I like that, especially because we could share with everybody, especially because I won, that the last similar wager we made, I came out ahead, fortunately, maybe luck, but I'll take it. So I think you're on with that. I believe you wanted to add, Brett, at this point, some thoughts about how Republicans versus Democrats view their perceptions of national economic conditions. Can you talk a little bit about what research you did?
Yeah, I know a lot of the listeners can't see the slide, but what you're looking at here is just a graph of who views economic conditions as excellent or good. And it's a Republican versus a Democrat graph. 10% of Republicans as of 2025 view the economy or the economic conditions as excellent or good, while 41% of Democrats view it as excellent or good. Now, I say that to say this, it's a very divided country. This we know. But if you look on the bottom of this chart too, it goes back presidencies from Bush, Obama, Trump, and Biden, and it shows a consistency, not so much in the Bush years with some negative performance, but over the Obama, Trump, and Biden years, the S&P 500 return has been pretty consistent. Anywhere from 16.3% under President Obama, 16% under Trump, and 13% under Biden. So even though that we have a divided outlook on how the economy looks, the markets and the S&P in particular, pretty consistent.
Yeah, I think we were at the dinner together with some clients, and I talked a little bit about with them because they've been clients of mine for a very long time about how in the first half of my career, the old adage about not talking religion and politics in business was a good guideline. But after the Great Recession, 2008, 2009, it became increasingly difficult to do our job, to be a financial planner, to forecast markets, to talk about investing opportunities and best practices without talking some politics, because politics is ever present in the economy. And the reality is, and this probably changed with the 2000 election, certainly changed with the 2016 election, is that if I'm sitting in front of a client that is a Democrat, I have to be cognizant, we have to be aware that their views are likely to going to be very different depending on who's in the White House or what party is in the White House versus a Republican. And I'm not making a commentary on what's right or wrong, whose views are right or wrong, but as we try and serve people, being aware that if you're a reliable Democrat voter, you're probably going to be a little bit more skeptical when you have a Republican in the White House. And it's the exact opposite. When a Democrat gets elected president, oftentimes Republicans all of a sudden become very nervous and risk averse. What's great about this data, and we've talked a lot about it, Brett, with our clients over the last stretch in the lead up to the election, is that history shows that there tends not to be much of a difference, including the last three presidential administrations. You're right, George W. Bush administration is a laggard. We could save that for a different time, but we like that we gave some good advice last year about, hey, listen, don't worry about who the next president's going to be. Let's look at best practices, fundamental economics, things that are going to work over the long term, because we help them capture good returns by avoiding a misstep based on political decision making, right?
Yep. Yes.
Cool. So I talked about U.S. spending. I believe, and I want to get your thoughts on this, I believe that this is something that's been around for a while. I mean, 10, 20, 30 years, the idea that the federal government spends too much, is accumulating too much debt. I believe, though, after what happened under the Trump administration and the acceleration under the Biden administration, that this is something that's going to become very much a topic in the public square, and the politicians will finally have to pay attention to it. Do you think that actually will materialize this time, or will it be the same as it's been year after year after year in the past, where it's talked about a little bit, but nothing comes of it?
I think it'll be interesting to see if there can be some real policy change. I mean, the number of the amount of interest the U.S. pays on its debt per year at over figures like 160, 170 billion dollars on debt. So, or last year alone. So, looking into what could happen, I would hope that there can be some good policy change just to slow it down. I mean, put some brakes on the car, maybe not try to crash the car into the wall and stop it immediately. But as long as there's a good trend down, I think that would be positive for the entire country.
Yeah, and I will say this is a little political, but there's this non-governmental committee that's going to be headed by Mr. Ramaswamy and Mr. Musk that is going to consult with sensible, that is a loaded word. One person's view of sensible might be another one's, but to try and find ways where the government could spend less, be more efficient, maybe use some best practices that are used in the private sector. I would love for that to be successful. I really am attracted to the idea that the government can maybe spend less money, but also get better results. That's what the private sector is often able to do, streamlining, using technology, good management techniques. The government so far the federal government has been immune to that. But I'm really hopeful for that because it would be wonderful if the government could spend a little less money or maybe even a lot less money, but get the same or better results. So I have great hope for that. We'll see. I know that's a politically charged topic, depending on your view of the incoming administration, but I do have a lot of hope for that.
Well, it's it's funny because everything that you just said and described is actually how a good business would be run.
Yes.
So my hope is that by running a good business that can translate into running the country as the same.
Yeah, I hope so. We'll see. Those two individuals are powerhouses. They seem to have the ear of President Trump. There'll be resistance from the administrative state and incumbency, and there's a lot of reasons why people that are advocates for a particular policy or department or issue will be resistant. But again, hopefully some good things could come of it. Let's move on to reasons to worry. I identified what the team put together is a couple of things. The S&P is historically expensive. The market index winners is narrow. There's some companies that have done really, really well and have carried the day, and a lot of companies have not participated in the mainline index numbers. I think you will share some data points on that in a moment. There's potential government ineffectiveness, all this optimism surrounding what might happen under the Trump administration. They're going to have to deliver, do a good job, and get good results. Otherwise, maybe there's too much optimism, and that could pose some problems. And then, of course, always geopolitical tumult. There's a lot of shooting around the world. But I think we're going to focus right on the S&P 500 being historically expensive and about the market indexes being narrow. So tell us what you found. I think you wanted to talk a little bit about the Magnificent Seven. Is that right?
Yeah, just wanted to kind of point that out because those have been some big topics in the news cycle, all over the news the past couple years here, and they've been terrific performers. So for the Magnificent Seven, for those who don't know, are the seven biggest companies inside the S&P 500. So Google or Alphabet, Amazon, Apple, Meta, Facebook, Microsoft, Nvidia, and Tesla. So obviously, all of those strong companies, strong performance over the past few years. And just to give you an idea, the S&P 500 returned, if you were to just use those seven companies this past year in 2024, those seven companies alone returned 48%. If you took the S&P 500 and took those seven companies out of it, so it leaves you the S&P 493, if you will, that those companies alone would have only returned 10%. So a huge difference in the leverage that those companies are making. And the point that you made as well, with the market being very expensive, with only those seven of 500 companies driving so much excessive growth. The question is, cautiously, how long can that go on?
Yeah, it's a great point because the forward PE of the S&P 500, I talked about this at length in the first economic update, is 22. That's historically high. And what's driving this is not most of the 500 companies that comprise the S&P 500, but is greatly impacted by the largest seven, the Magnificent Seven, as it's been coined. They are very, very expensive. And because of their success, they've really driven up the overall price to earnings ratio. And so the Magnificent Seven is key. If they should stumble, if you're listening to this, if they should stumble, you would need to have another industry or two pick up the torch in order for us to continue to make gains in the market. Or they'll have to continue to being red hot, which could happen. But history as a guide, we've had other episodes in the past where a couple of companies or an industry get red hot, but that doesn't last forever. They will come down to earth. competition will take over. So it's kind of a tricky proposition for the market this year, and it's something that's given me and the team a little pause about our optimism this year. And generally I would describe as realists. We never get too excited, and we never get too down either. But this is, I think, a key point that gives me worry this year. Can the Magnificent Seven keep going? Or if not, where would you find returns? What industry, what companies would be able to step up their game, if you will, and pick up the torch? Is that a good summary, Brett?
It is. And I think that also piggybacks on client expectations as well. So looking at what the market's done the past 2 years, especially in the Magnificent Seven area, 48% return, 30% return isn't usual. It does happen from time to time, but it's kind of just tampering what expectations should be.
Yeah, that is a good point. We've had a great run since October 2022, the new bull market that was given, that came into existence after a terrible first part of 2022. That was seriously driven by the bad inflation situation we had for most of 2022. So this bull market will not last forever, but that doesn't mean it's about to end either. But to your point, historically, companies that are growing 48% a year will not do that for as long as the eye can see. It will have an expiration date. So we want to be mindful of that. You want to talk a little bit about the price to earnings ratio? Did you have something to add to my view on the market's expensive and we're a little worried about that?
Yeah, I just wanted to add in the chart that's in front of us here is just the S&P 500 over time. You can just kind of get an idea of how it's raised and fallen, and how the PE ratio as well has kind of lifted on big bull markets, but then also pull back to more down to earth level when the market does have a pullback. One notable thing, just kind of taking the 30,000-foot overview, is this chart goes back to 1996. In 1996, the S&P 500 was sitting around a whopping 700 points, and now it's over 6,000, or right near 6,000. So that just goes back to the fundamentals of, as long as you stay invested inside of your risk class, over time, you can make your money grow and grow your wealth.
Good point. Good point. And the price to earnings ratio, let me add on a more optimistic spin. You could make the case that because we are in a state of technological innovation driven by robotics, AI, quantum computing power, there's some powerful things going on, and you may not see it in a clear way day to day, depending on what your job is and where you are in your life cycle. But there's some immense changes going on with this new technologies that are going to increasingly change how we interact, the world. I mean, this is powerful stuff. During technological innovation periods like this, you often get extended price to earnings ratios for a while because there's so much optimism about economic growth and profits and increased revenues down the line. So that's just a quick history lesson, and a little bit of a reason why maybe this PE ratio could last a little while.
Yeah, absolutely. I like your perspective on it, and I think that over time this might last longer than we expect it to.
Very good. And I wanted to tee up kind of one of the last points you wanted to add to what we had put together in the first version of this, is that, let me just give a backdrop for listeners, is that the US stock market has outperformed the rest of the world stock markets by and large for a very long time. You're talking about 10, 15, 20 years. You could find exceptions in any given year. You know, XYZ country one year may do better than the US. But generally speaking, the US stock market has provided the most consistent and the best returns for quite a while now. So the idea of investing in international to diversify makes sense to a certain point, but it hasn't really worked very, very well for a while now. But we're at a point where things start to look appealing in many ways. So, Brett, tell us what you wanted to share.
I just wanted to show the severe difference between the international price to earnings and the international indexes and prices as opposed to the S&P 500 in the US. So as the US has had a sharp increase upwards, the international graph looks exactly the opposite. Looks like a big mountain that somebody fell off of. So Chris, to your point, now is an interesting time because international pricing is so cheap. Now, could it get even cheaper? Perhaps. But at the same time, it's down so low, it just presents an interesting opportunity of when that will turn back around and how that will interact with the new US and world economy coming up here soon.
Yeah, and I've been an international investor for a very long time. I've largely stuck with it to differing degrees, and for a lot of our clients, we've avoided much, if any, international over the last bunch of years, and that's been beneficial. I think if you're listening to this, you could sense that as a team, we kind of are attracted to the relative value that you could invest perhaps in a company overseas that you can pay less for the stock compared to the similar US company. So there's relative value there that's interesting. Although that's been the case for a while and it hasn't worked out, yet we've taken note of it because the US stock market now has gotten to the point where it's historically expensive. So it's something that we're going to watch and we're going to look at. From a geopolitical standpoint, let me also add that part of the reason this is the case is, and this is going to be a little bit of a me on my soapbox, Brett, but we like as Americans to kind of criticize the government, the economy, CEOs, whatever, right? And we kind of, it's almost like infighting, family infighting. But when you look at other countries around the world, they would swap their problems for our problems in a second. We are dominating around the world by many metrics, and our friends and our adversaries, China, for example, has had a very rough 10 years. Europe has been stagnant for a very long time. The reason why these ratios are in place is partly geopolitical, is that the US has gotten relatively stronger economically compared to a lot of its friends and adversaries around the world. I think sometimes we lose sight of this because we like to just criticize things that do need improvement in this country, but we don't realize that other countries are dealing with bigger, more significant and deeper problems. How's that for American patriotism? I'm going to have a piece of apple pie or something.
I'm going to have to change my background to red, white, and blue after that.
There you go. I love it. But you agree with that, right?
I do, absolutely. We're lucky to be where we are, and I think that as investors, it's great in the era that we live in now with so much access to information that we haven't had before. Really helps us make our investing decisions that much easier, if you will, just due to the fact we have access to so much.
Awesome. So as we wrap up, everyone, and thank you, Brett, for joining me today. This is a great discussion. I suspect, and I'm confident that anybody listening to this is getting a value out of hearing us banter back and forth and some of our insights. But if you're a client of ours, or if you're considering becoming a client of ours, please know what you could expect from us is a regular review of changes that may affect you. We're going to communicate regularly, including webinars and broadcasts like this, podcasts, mailing, as well as personal communication. We're going to review economic changes, tax, estate, and investment issues so that we could serve our clients well. Your health and your well-being is our highest priority. Brett and I and the rest of the team here at Elliott Wealth Management, we appreciate the opportunity to assist you with your financial needs, and we are always planning for your success together. Thanks for listening today. Thanks again, Brett. I'll talk to you soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.